even if you can get into a property with no money down, that doesn't mean you should. You have a lot of exposure there. You're leveraged to the hilt. If you can't get into a property and know upfront that you can increase the value by a good 20 to 30%, you really should take a property even if it is no money down.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 191. I've been excited to have today's guest on the show ever since I had the pleasure of reading his best-selling book, which some of you may be familiar with. It's called Crushing It in Apartments and Commercial Real Estate: How a Small Investor Can Make It Big. Brian Murray is the founder and CEO of Washington Street Properties, which owns and operates a large portfolio of assets in upstate New York, including apartments, office buildings, retail centers, storage, billboards, parking, and mixed-use properties. Washington Street Properties has been ranked on the Inc. 5000 list of nation's fastest-growing private companies for 5 years in a row. And Brian has built its entire portfolio through value add without raising any outside capital. And we're going to find out how he did that today. Brian, it's a pleasure having you on the show.
It's a pleasure to be here, Brian. Thank you.
For those who haven't read your book, and I highly encourage that people go out and get your book. It's called Crushing It in Apartments and Commercial Real Estate. I read it. It's a fantastic book. You have a lot of great stories. You're a great storyteller. Why don't we start with you telling us a story about how you got started investing in real estate?
Yeah, I'd be glad to. I bought my first property about 12 years ago, and I was working as a teacher at the time, and I realized that I was having some trouble making ends meet, and I really, I had changed careers from a career that I was better paying, and I was looking to supplement my income somehow. I realized I was kind of eating through my last remaining savings, and I said, I've got to turn things around. And I'd always had an interest in real estate, and I thought maybe if I took that savings and invested it into something that would earn me some additional income, that would be a good idea. So I went out and started looking at rental properties. And, initially I was looking at single family homes and duplexes and running some numbers, trying to figure out, how I could make this work. And, I wasn't finding that I was get the returns that I was hoping for. And I started to look at larger properties and got a little more excited. And I had a limited amount of funds to work with, so I really wasn't sure how big of a property I could get. But as I educated myself and talked to more people, read a lot of books, I began to realize, hey, there are some creative ways that you can buy a commercial property with less money down than I had expected. And I still remember when a broker brought me a pretty large property, quite a bit bigger than I thought I could have ever afforded, and explained to me that, hey, this particular seller is really motivated to sell, and they're offering owner financing. And they explained that to me, and I recognized that how that would work from my self-education. And but having someone bring it to me and seeing an actual property like that really made it real. So I started looking at much larger properties, and eventually I came across one that was a 50,000 square foot office building that was in pretty severe distress. It was losing a lot of money. But the more I looked at it, the more I became convinced that there were things that I could do to turn it around. And I drained my savings in my retirement account and went all in and bought a large property right out of the gate. I'm not advocating that approach for your listeners because it was pretty risky, and it did work out in the end. But when I looked at this property, the waste that I saw was just mind-boggling. I couldn't believe that they would spend all this money on things that were, unnecessary. It just wasn't well looked after. There was a full-time staff person there who really wasn't doing anything to help the property. He had a wood shop set up there where he worked on things on the side for himself, and the heat was on full blast in the winter. There was no control, so if people wanted to cool off, they'd open the windows in the middle of the winter, and then in the summer when it was super hot and they ran the air conditioner on full blast all the time, including in the middle of the night and weekends. And when it was too cold, everybody would open the windows to warm it up. So some of these things, even though I hadn't invested before, I knew they weren't right, and I knew it was super wasteful. And when I looked through the numbers, I realized that I could pretty quickly make that place cash flow positive, and from there I could just continue to invest in it and turn it around.
Well, let's talk about that a little bit, because in your book, I'm assuming this is the solar building project?
Nope, this one was the solar building project came later. So this one was an office building.
Okay.
And yep. So it definitely was. I didn't even know the term value add at that time, but that's exactly what it was, and it kind of set the tone going forward. It was just a big value add project.
Yeah, and this would have turned any beginning real estate investor, most beginning real estate investors, off from investing entirely. But you seem to have just embraced it and embraced the challenge, and you were able to turn it around. Tell us about some of the challenges you faced in turning this office building around.
Well, some of it was pretty intimidating. While some of it was straightforward. So some of the easy ones right out of the gate was I had a full-time person who had a fully loaded salary of about $50,000, and on the first day I let him go. And actually, by the end of that first day, just from firing that person, I got at least it to cash flow, barely, but that would make it cash flow. Using the actual thermostat, turning the heat or air conditioning down at night or on weekends, or actually having it regulated according to the temperatures. I actually, in the first year, I cut the heating bill and the electric bill, the utilities got cut in half because there was no effort at all to control those.
Wow! So stop right there. Stop right there. Those are two low-hanging fruit. Yep. Items. Yeah, firing the guy who's overpaid and not really doing his job, and then just putting some simple controls on the utility bills. And I've seen that as well in some of my properties, where that can have just a huge effect right from day one.
Yeah.
However, in firing the full-time guy, didn't that mean you then became the manager?
It did. And I was prepared for that. Working as a teacher, one of the benefits of that is it is a fairly forgiving schedule. You get a lot of days off, and but it still wasn't easy. I got up before dawn every day, and I came in and I worked at the property since it was local. And especially in the wintertime, I'd come in very early and have to clear the snow and the ice, and there are a lot of sidewalks there. And I'd open the building up and walk the property, turn the lights on, get it ready for the day, and do any work that needed to be done. And then I'd go off to my day job. Because it was so close by, sometimes I could sneak off during a lunch break or sometime during the day, and then I'd come back at the end of the day and get more work done. And a lot of my evenings were spent drafting leases and writing lease proposals and doing things that I could do from home as well. So those early years when I was first getting started, I definitely had to make a lot of sacrifices and it's put in a lot of hours to make it work.
Yeah. So what were some of the people challenges that you faced?
Well, I think right out of the gate, it was really helpful to realize that some of the more complicated things, and it could be anything, whether it was a legal issue or a heating issue or anything like that, I began to realize that I could track down somebody with the right skills to address almost every problem. And I think that was really important to kind of recognize right up front that, hey, I'm not an expert in any of these things. and I shouldn't pretend to be. I can shovel and I can turn on lights and I can do maybe a few other things that don't require a tremendous amount of skill. But I think in that first year especially, the challenge was to build that team, find those people that I could turn to call upon for anything that I needed. And once you realize that you can reach out and call somebody, a lot of those scary things with a big rental property become a whole lot less intimidating. And you say, hey, no matter what I need to do, I can pick up the phone, I can call somebody, and they can help me figure this out.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Why is it that this challenge didn't scare you off from continuing in investing in real estate?
Probably the biggest reason is that I saw results from my hard work, and the prior this was a property that was right in the middle of the downtown of the community. It had a lot of history, and everyone was aware that it had been let go and wasn't being properly taken care of. So people were very leery about considering to locate their business there. Brokers didn't want to show it because they had not been paid commissions in the past, and contractors didn't want to work there because their bills didn't get paid, and they had a bad reputation. But one of the great things that happened is when we first bought the property, the newspaper ran a story and told everyone that, hey, that property's been sold and it's under local ownership, and my presence there, going out in front and cleaning every morning, and we did plantings, we cleaned the place up. The landscaping was a mess. There had been trash all over, and it was very quickly evident to everyone, the tenants and people in the community, that something had changed there and things were going well. And right after the newspaper story came out, a good tenant came to us and sought me out and said, "Hey, we've always wanted to be in that building, but we've been scared to be there because of who the owners are. And, we'd like to move in." And that was kind of the beginning. A property that was right around half full, 3 years later was full, and it was cash flowing. And so, at that point, I said, "Hey, let's do this again," right? And that's not to say there weren't a lot of challenges, because we had a ton of setbacks and it was not easy, but it was rewarding to see the improvements and physically, but also financially, that this place was blooming, and I felt more confidence that, hey, if I could find the right opportunity, I could do it again.
Yeah. So what were some of the financials on this property? I mean, how much did you pay for it? And what was the net operating income when you first bought it compared to where you were able to get it up to?
I paid, it's kind of an interesting longer story, and I don't remember the exact numbers, but I had it under contract for a higher price than I eventually purchased it for. I ended up buying it for $834,000. And what happened was I kept finding surprises that the seller had misled me. And to this day, I don't like renegotiating, and they call it retrading. We go back and try to renegotiate the price. But if a seller has misled you and given you false information, and that's what you base your price off of, you're fully within your rights to do that. And that was the case here. So I did get a lower price. I negotiated credits at closing, and I ended up having to come up with less than 10% of the purchase price out of pocket. And that's how I was able to get into a large property, and at a reasonable price. I assumed the mortgage and paid the rest in cash. The net operating income at the time I don't remember the exact number, but it was not breaking even cash flow wise. It was in the red, and so not net operating income was pretty low, and but right out of the gate, just by getting rid of the employee, I was able to boost that up by about $50,000 on the first day.
Wow. So you were able to add pretty significant value. How do you still own that property? How's it running today?
Still own that property. It's actually our company headquarters is located there, and it's doing great. It stays full or nearly full, and we've invested in almost every aspect of that property. Every year we're putting more money in, and that's been one of the ironic things about it is right from the beginning. My whole motivation to get into the rental property was to generate that extra income. But what I found was that I was so invested in this property that I was putting all the money back in. So I found that I wasn't willing to, even though I could have pulled money out, I committed myself to putting every dime back in and keeping my day job. Even after my business grew, one of the ways I was able to grow such a large portfolio in such a reasonably short amount of time was that I kept that job for many years afterwards. And it wasn't until our company revenue was well up over $2 million a year that I even considered leaving that day job. I really began to love the business and what I was growing, and I got excited about it, and I was motivated to keep putting money back in. And it's amazing what you can do if you're willing to make that sacrifice and keep reinvesting.
Yeah. So was it reinvesting back into that building, or then also reinvesting into your business through other acquisitions?
It was both. So initially, it was just reinvesting back into that building. And it took a couple of years really until, I started at a pretty bad time in terms of the economic environment and the lending environment. And, I couldn't get anybody to lend to me. A couple of years in, when the property was performing fantastically and the situation got a little bit better in the markets, I did finally get a mortgage. And with that first mortgage, I did a cash out refi and used that money to buy my next properties. In the meantime, I picked up another one that was this one wasn't the first one was one of them was an owner financing, and one of them was an assumed mortgage. So between those two, I had the first two, and then the cash out refi, I bought two more after that. And that's actually the first time I got into multifamily. Is one of the properties I bought was a 30-unit apartment complex.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional healthcare insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbAssociatesllc.com. So let's talk about that transition from investing in office to all of a sudden investing in multifamily. It's two completely different things in a lot of ways. What were some of the things you discovered when you switched over to multifamily?
So it's interesting, looking back and knowing what I know today, because actually over the years we began to gradually move more and more into multifamily, and now we're probably 2/3 to 3/4 of our business is multifamily. And knowing what I know now, you can see the differences, but not having been in the industry, I really didn't look at it any differently. I saw a property that wasn't well taken care of. I saw opportunity. I said, hey, if we can come in and manage this and invest in it and take care of it, we can really boost the value of this property and turn it around. And in many ways, it really wasn't that much different than an office building. I think that the similarities are probably more than the differences. And there are some differences, though, certainly. But the basic principle was the same, right? It actually was easier. Everyone had the same lease. You could have a lease template that you could use a lot more easily in offices and retail. A lot of times it's very unique to each individual tenant. Not always that way, but many times it is. And it was a different type of tenant, and there were other things that you had to be aware of, but it certainly wasn't any more complicated than another commercial property. And in the end, our approach, which was to add value and invest back in, worked just as well with a multifamily as it did with an office. And from that point, we just kept growing.
Now, was this initial multifamily, was it as much of a value add project as the office building had been?
It was probably not as much, but it had a lot of value add. It was very, very poorly managed. There was one part-time maintenance person who really only showed up if there was an emergency situation. There was very little routine maintenance. That same part-time maintenance person was the one who would he didn't actually do showings. When someone wanted to view an apartment, they would say what time they could show up, and the maintenance person would come early and unlock the unit, and then the prospective tenant would go in and view it on their own. So there actually were no showings, and it just was very neglected. There was one unit that was completely caked in mold, like I had never seen. It was like stalagmites and stalactites in there. I felt like I was walking into a cave. I've never seen that much mold in any other property ever. It had to be completely gutted down to the studs and built out from there. So that was one down unit that and that's actually one of our keys to success too. I sometimes call it taming the beast. It's these really scary things that would deter almost everybody else. Most of those things can be solved. Most of those things have a solution. And I think people early on, they get told so often when they're exposed to real estate, oh, these are the things you need to avoid. Oh, if it's a structural issue or an environmental issue or mold or and people have it ingrained in them that if you see these things, you run the other way. Well, you can hire a company to come in and address the mold, and there's a price associated with that. And it's really not that much in the grand scheme of things when you're buying a 30-unit property. So that's another key to our successes, is where we haven't been scared away by things that might scare away other people.
How did you go about solving some of the other challenges you had at that property?
I actually think that it also was helpful that when we switched from offices, and by that time we had some retail, to multifamily, we had established a standard of service in the office, in an office environment that was pretty high. And was high, particularly relative to the way most multifamily is managed. I found that I had in my background experience with customer service and customer care. I didn't have any real estate in my background, but I always thought the customer should come first. Customer service, customer satisfaction was really important. And to bring that mindset into real estate, at the time, it seemed obvious to me. But what I learned later on is how rare that was to find in real estate. And so, I think as we made that transition, we applied those same levels of care and responsiveness to the multifamily tenants, and we still do our best to provide that today. And I think that's been really important.
It's interesting that going back to this time period, you're a teacher, full-time teacher. Not only are you investing in an office building and a multifamily, but you're building a management team. You're building a company as well. So you're wearing many, many different hats. How were you able to juggle all of that?
I think I was really fortunate early on to pick the right people. I didn't hire somebody until about 2 years in. And I hired a superintendent at that time to handle a lot of the maintenance duties and take that off my plate. And the next person was more kind of property management oriented. Somebody who could do some bookkeeping and do showings and do some of the more administrative type things and property management type stuff. And it was a good combination. I started with those two people. And then from there, just progressively grew. Eventually got large enough to have a couple more maintenance staff and then a leasing consultant. I think that, like I said, I think I got fortunate that I had some fairly responsible people early on who took pride in their work and didn't have to have that oversight. And that's hard to find, those people that are they're gonna take pride in the properties. You don't need to be looking over their shoulder or checking on them, that you can trust that they're going to do the right thing. If I had hired the wrong person in one of those early hires, it could have been a really big problem.
Yeah. So what is your secret then to finding the right person?
I wish I had the answer to that. But it's, I think, probably the best hires that I've had, certainly the highest success rate, is people who are referred to me. And so, I had gotten those first two hires. Those were people. The first one, they had somebody referred me to that person to come over and help me solve some situations. They weren't an employee, but he came by and just helped out, just to explain to me how to do something. And I got to see, what he was like and observe him firsthand. And, I think that referral makes a huge difference. And then the other person was someone who I had gotten to know in another context. And so, there was that trust right out of the gate. But if I think back on all the hires, both as I grew my real estate company and in prior business experience, probably your most successful, like in terms of percentage outcome hire rate, is people who are referred to you by someone who's seen them perform somewhere else.
During this period of growth where you're financing everything as your funds are available, did you ever come across opportunities that you had to pass on because you didn't have enough money to do those deals?
All the time. Yeah. I think if I go back and, if I kind of dissect every deal, there was and there is to this day, there's creative financing elements in the vast majority of the projects that I've done. It's been a big part of how I've been able to grow like that. I think for every one of those projects that I execute on, there's 100 others that don't get talked about that just didn't work out for some reason or another. And so it's hard because I talk to a lot of people who are just getting started. They hear about these types of deals that I work out, and they say, well, I've looked and I can't find one of those, because I've had a handful of deals that I've gotten in with no cash out of pocket at all. And some of them not that long ago. And I'll have people swear that in today's market, that's impossible. You just can't do that. And what I would say is that that's not true. I can prove that's not true. And you've got to look so hard and turn over so many stones and talk to so many people till you find that right situation to make that happen, that very few people are willing to put in the effort to do that. So they don't just pop out and, wave at you and say, hey, here's a situation. Some of these, it's because I reached out to somebody year after year for many, many years, and they got to know me a little bit. When they finally decided to sell, they called me. I got to know a little bit about their own goals and what they're trying to accomplish with a sale. And sometimes we can structure something that makes a lot of sense for them and makes it easier for me, and everybody wins.
Yeah, so it sounds like you're building relationships with people over a period of time. And then you're the first person they think of when they decide to sell, and quite often they'll consider holding the note. Is that what I'm hearing?
Sometimes they'll hold the note. If you build a little bit of trust, they will give you a little more insight into their debt situation where you might be able to work something out with them. A lot of times somebody doesn't want to hold a note, and you think that as a buyer, they can't have a mortgage if they're going to hold a note. But I've structured a lot of my deals where there's bank financing, but then I have a seller take a second position. And I do that quite often. And many times, especially if a seller feels like they can get the price they really want, they're willing to carry 5% or 10% or 15%. And if you work with a local lender, they have the discretion to lend in those situations, as long as it's a second position, and as long as you can cover your debt and meet their lending criteria for their debt service coverage. So you might have somebody who wouldn't have otherwise thought about taking a second position, and oftentimes I'll start off with an offer that I know I'm going to get a counter, and I don't include owner financing in my first offer. I think if you go right out of the gate with that, sometimes that can turn somebody off, especially if they aren't familiar with it. So a lot of times I'll wait for the counter, and then I'll come back and I'll say, well, I think I can do better. And, here's a counter, but in order to raise my price, I'd like you to carry back 5%. And, a lot of times they're still going to clear a huge profit, and maybe they've already, they've held the property for a while and they've paid down their debt. And so they say 5% plus that can, defer some of their capital gains if they're not going to exchange the property into another one. And then they start to think about, they see the terms of it and they realize, I'm going to get a check in the mail for the next 5 years. Every month I'm going to be earning interest on this money. A lot of times they don't know what they're going to do with the proceeds when they exit the property. Sometimes they don't want to get another property, but they want to have income that they can rely on, and they want to earn interest, and they're not very happy with their options. And so if they see it structured, maybe you start small, and then, after you've gone back and forth a few times, you get a price that they're really happy with. And next thing you know, you've got them lending you 15 or 20% of the deal.
It sounds like you're able to get really creative then with structuring some of these deals. How do you know what terms to offer when you're talking to a seller and saying, okay, well, I can pay you a little bit more, but you need to carry a note? I mean, is there a ratio you follow, or are you just looking at your spreadsheet to see where the numbers fall?
Yeah, I mean, I'm modeling everything out. I know what my target is in terms of how low I'm willing to go on a cap rate, and I'm doing the best I can to keep my price where it's going to perform and hit those numbers that I want to achieve. It's not always possible. In today's market, it's more challenging. It's become very common for people to pay for value that they haven't yet realized. So whereas in the past, it was a very strong rule to say, don't pay for what's not there. If a seller wants more money, the lower rents is the classic example. Somebody's going to sell a property and they say, well, my rents are all $100 a month too low. They could be raised. And so you should pay as if the rents are $100 higher. And, 5 years ago, everybody would be like, no, like if you want somebody to pay that amount of money, go ahead and raise the rents, and then it's worth it, and then sell it for that much. And today you'll find that people are, they're willing to pay for that up front. And so it becomes more challenging to find those value add opportunities that go deeper, where you can still create that value. Because frankly, even if you can get into a property with no money down, that doesn't mean you should. You have a lot of exposure there. You're leveraged to the hilt. So if you can't get into a property and know up front that you can increase the value by a good 20 to 30%, you really shouldn't take a property, even if it is no money down. So we're really selective, and just because you can do it doesn't mean you should. Everything needs to work. The numbers need to work. And if I'm going to borrow 90% of a purchase price, I need to feel pretty confident that I can add 15, 20% value to that property within a year for me to be comfortable with it.
So give me an example then of when maybe you've done this, or maybe you've considered it, where you've actually paid more for the property based on the upside. Because like you say, 5 years ago, you would basically pay based on the current net operating income. But now sellers expect to be paid on the upside that's there too. Have you ever paid more for a property, and why?
I have. I haven't done it very often. There was one occasion not that long ago, within the last couple of years, that on a smaller office property, I did do something like that, and it was a difficult decision. But this was a property that modeled out at I don't remember the exact numbers, but I valued it maybe $280,000 or so. It was half empty, and the seller had been trying to fill it for a long time with no success. Now, they were out of state. They really didn't have their finger on the pulse of what was going on. They didn't have the relationships, things like that. And I looked at the property and I said, it's not, office space is harder to lease, but I think if we were to make some improvements here, we could lease it. But I value the property, and they had originally been asking upwards of $400,000+ for this property, but they didn't have any luck. They had been bringing the price down, and they just were ready to sell. And I said, listen, here's my numbers. I actually showed them the numbers, and I said, I'm valuing this at 280, and they're like, we can't go that low. We owe 320 or so. And so I said, well, that's unfortunately, that this is what it's worth, and that's what you owe. You're underwater, and not only that, but there's a lot of deferred maintenance here. So in the end, I agreed to assume their mortgage and purchase the property with no money in. I found out who the lender was. I had to check in with the lender to see if this would be something that they would consider. I'd worked with them before, so they were comfortable with my plan. And so I bought the property for no money down. I technically paid an extra probably $40,000 for it. I actually got a credit back from that closing for some of the deferred maintenance to help me with some of the costs to fix it up. And then I invested in some improvements to the property. And it took me a year, but I filled up the rest of the space. And then I actually recently sold that property for $400,000.
Nice. You're like a turnaround artist.
Yeah, I mean, generally, I don't like to sell. I'm definitely primarily a buy and hold investor. More recently, I've taken a few of my smaller properties and sold them in order to finance some larger acquisitions. So, but I definitely recommend buy and hold as much as possible.
Let's talk about your new direction. It sounds like you're transitioning from self-financing all of your properties, or at least bringing in your own equity to the properties that you're investing in. And now you're looking at syndication. Why are you considering that? Well,
as my company has grown, it's become increasingly challenging to grow at the rates that we had become accustomed to. When you grow organically, growth is slower. And particularly now when the returns that you can get on a property aren't as high. So cap rates have just steadily gotten lower and lower over pretty much the entire time that the last 12 years since I started. And so we're still getting good returns, but to try to get the level of growth that we've achieved this far is very challenging. The other challenge with organic growth is you're cash poor all the time, right? So that you keep putting that money in, and it's you've just reached a point in time where I said, it's becoming so hard to grow the way we've grown. Maybe it's time to grow in other ways. So we're continuing to invest the way we have before, but now we will consider other opportunities where I've had the pleasure of meeting people like yourself and people in a mastermind that you and I are members of, who raise money and are really looking for the good deals that they can put it to work for them. So I can partner, which I haven't really done in the past, and bring some outside equity into those opportunities. And, it can be rewarding in another way, which is that, In the past, it's rewarding to help the tenants, the community, make all those improvements. Well, I decided might be time to help some other investors who are maybe they don't have time to be active investors and they want to be passive, or they're just getting started, and being being a limited partner is a way to get their foot in the door, and why not share the wealth and get some other people opportunities and allow my company to continue to grow.
So I want to talk about a couple other things here before we wrap it up. You've invested in quite a lot of different asset classes: storage, parking, billboards, office, mixed use, retail, multifamily apartments. Do you have a favorite, or do you kind of see them all as sort of the same thing?
The basic principles are all the same, probably more so than most people realize. But, I love to learn. I love to try new things. It's always been exciting to learn about a new type of asset, give it a try, see if it's something that we get excited about. And, they've all got their pros and cons. At this point, we've really decided to focus on multifamily going forward. Doesn't mean we wouldn't be opportunistic in other areas if the great opportunity came along, but our primary focus going forward is multifamily. We really like that, even though the valuations are a little richer right now. Both myself and my team, we find that very rewarding to go into a community like that and make improvements and work with the tenants, and it's got a lot of things going for it. I like the big picture trends, and there's a lot more safety in there. You have a lot more control in terms of the income with apartments. It's very challenging when you have vacant commercial space. You can adjust the rent up or down and not see a reaction from the market. Like it's harder to gauge when somebody's going to leave, and to backfill spaces. With an apartment community, you can adjust the rents, and you usually will see a pretty quick response from the market. So if you need to boost occupancy and you tweak your rents or you do a concession, you get an immediate response, and we like that.
So let's also make sure we talk about your book here too. Tell me why you wrote this book in the first place. I mean, you had so much going on. It's hard to imagine you carving out enough time to write Crushing It in Apartments and Commercial Real Estate.
Yeah, that's one thing I didn't have a lot of was time. That's true. But one thing I find really rewarding is helping out other investors, and I do that as much as I can. And going back a few years, I had begun to mentor some local investors, and the more success I had in real estate, the more people that came to me, and the more I realized that I just can't do this. Like it takes up too much time. So I felt really bad about that because, I was a teacher. I love to teach. I love to help other people. It's very rewarding to do that. But frankly, I just I couldn't do it. And the more I got inquiries and requests for help, I said, I have this deep desire to help people along this path. How can I reach as many people as possible given my time constraints? And I made the really difficult decision that I said, you know what, I'm going to put everything that I would share with someone that I was mentoring into a book. I'm going to write it all down, and all these people that are, coming to me asking questions, it's all going to be in there. And I really didn't have time to do it. And I spent a few years, like every spare moment, writing and put it all together. And, I think one of the pieces of feedback I get from people is I felt like there was somebody like you were there, like walking me through things, coaching me. And that was the goal. Like the goal was to say, I want to help people. I want to get it out there. I never expected to make money from the book. It's been overwhelming, the response, but it wasn't something I anticipated. The idea was have it available so that anybody that reached out for help, I could point to it and go, listen, I put all my mistakes, everything I've learned. If I was to give advice, it's in there. It's pretty rare if I tell somebody, if you read the whole book and you still have questions, let me know. They almost never do. Like I pretty much put everything I know in there. I've learned enough since that I may actually start writing another one soon, but as a follow-up. But I think as someone who's a small investor or just getting started out, if they want to they want to dig in and like hear about some of the stories about what I experienced and my advice, and maybe be able to pick up some tips or, learn from my mistakes. It's that, the book is a great resource for that.
What's more rewarding, having written the book and the reaction you get from the book, or actually investing in real estate?
Well, that's a really difficult question. So I find both rewarding. I think that it's been, it's kind of hard to describe how rewarding it is, but I've had so many people reach out at this point to say that the book has literally changed their lives. There's quite a few investors out there now with entire portfolios, people who've left their job who reach out to me and say it was the book that lit my fire. That's, I attribute what I did to the book. Just to know that it's made that big of a difference in people's lives, that's been so, I feel so blessed to be able to say that. And so, I think while that wasn't why I wrote it, to hear that or get that feedback, it's been extremely rewarding, and it's hard to compare to.
Yeah, and I'll say this: I read your book. You tell great stories in the book, but I think what's really strong about it, and the stories are strong, of course, but what's really strong and what stands out is the fact that you are a teacher and you do a great job of just teaching the concepts. I highly recommend the book. And where can people find it?
Best place to pick it up is on Amazon.com.
If people want to get a hold of you, how would they do so?
I think probably the best way is through LinkedIn or Facebook. I have a presence on both of those. My email address is brian@washingtonstreetproperties.com, all spelled out, washingtonstreetproperties.com. And so, of course, someone could reach me by email. The book has a website, crushingit.info, and if someone goes through there's a contact form. People can fill out the contact form and reach me through there as well.
And any parting advice for our listeners who may have read your book and are really interested in getting into commercial real estate investing, but haven't yet pulled the trigger? What would you say to them?
It doesn't need to be complicated. Be prepared to put the effort in, and don't be intimidated. You can find a resource to solve almost any problem that might come up, and go about it in the right way, right? So remember, your tenants are your customers. Provide great customer service. Be responsive. Treat people well. Do things the right way. Work hard, and sky's the limit. Well,
Brian, thanks so much for sharing your experience with us. A lot of it's in your book, and I highly recommend that. Crushing It in Apartments and Commercial Real Estate. I've really enjoyed hearing your stories about your office building that you invested in, how you were able to build your portfolio without raising money from other people, which is really incredible. And just the different types of asset classes you're investing in, and your general philosophy. It's been very enlightening. Thanks so much for being on the show.
Thanks for having me, Brian. I really appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.